Welcome back in macroeconomics class. Our today topic is business cycle. So what is business cycle and what are their different stages? So now in today's class we will discuss different stages of business cycle, and for the coming class we will discuss about their theories about Samuelson theory and Hicks theory. Business cycle. This is the alternate phase of the business's activity. On y-axis we have level of business activities and on x-axis we have number of years. So in this picture there is the first stage where recovery or the business is started, and the second stage is the expansion stage. The third stage is the boom or the peak stage. The fourth stage is recession, the fifth stage is depression, and the last one is trough. And this line is all about equilibrium line or the full employment line. So in this stage, in this business cycle, we will discuss all these stages one by one. So a model showing the increase and decrease in a nation real GDP over time. This model typically demonstrates an increase in real GDP over the long run, combined with short-run fluctuations in output. This is business cycle. Recovery. In this phase, there is a turnaround in the economy and it begins to recover from the negative growth rate. Demand starts to pick up due to low prices, and consequently supply begins to increase. The population develop a positive attitude toward investment and employment, and ultimately the production start increasing. Employment begins to rise, and due to accumulated cash balances with the bankers, lending also shows positive signals. In this phase, depreciated capital is replaced, leading to new investment in the production process. Recovery continues until the economy returns to steady growth level. Expansion. In this phase, there is an increase in positive economic indicators such as employment, income, output, wages, profit, demand and supply of goods and services. Debtors are generally paying their debt on time, and the velocity of the money supply is high at that period, and investment is also high. This process continues as long as economic conditions are favorable for expansion. So, in this stage, all these indicators like employment, income are interrelated to each other. So in this stage, when the employment increases, income automatically increase, and when income increase, the output increases, and when output increases, the wages they increase, and when the wages increase, the uh, profit increases. And so when people have more money, so they increase or expand their demand and supply of goods and services. So this is the expansion period of the business cycle. The next stage is peak or boom period, where the economy then reaches a saturation point or the peak of the business cycle. The maximum limit of growth is attained at this time or at that period. The economic indicators do not grow further and are at their highest. Prices are at their peak. This stage marked the reversal point in the trend of economic growth. Consumers tend to restructure their budget at this point. Now the next stage is recession. The recession is a stage that follows the peak phase. The demand for goods and services start declining rapidly and steadily in this phase. Producers do not notice the decrease in the demand instantly and go on producing, which create a situation of excess supply in the market. Prices tend to fall. All positive economic indicators such as income, output, wages, employment, etc., consequently start to fall. Depression is the next stage where the growth in the economy continues to decline, and as this falls below the steady growth line, the stage is called a depression. The last stage is trough. In the depression stage, the economy's growth rate became negative. There is a further decline in this stage until the prices of the factors as well as the demand and supply of goods and services contract to reach their lowest point. The economy eventually reaches the trough. It is the negative saturation point for an economy, and there is extensive depletion of national income and expenditure.